10% return if I will invest my fund in stock market? I say, no, I will not give. This is may or may not be possible. Maybe you will get 20%. Then he say, maybe we will get 2%. Yes, but into bank, I will get regular income 10%. So I am satisfied with 10%, no problem. I don't need more than 10%, regular income. Safety of principle. Whatever I am investing into bank, that is safe. I am not losing my principal. As well as my return is fixed, liquidity is there. So the risk aversion objective is this. Is that clear? So, knowledge. What is knowledge? The knowledge about the investment and markets plays a key role in the policy formulation. You cannot formulate the policy until and unless you have good knowledge and the market. So the person who is investing the money must have the knowledge about the market and about the alternative, investment alternative. Otherwise they will not formulate, otherwise that investors cannot formulate his investment policy. Very difficult. The investment alternatives range from security to real estates, because alternatives are there. Where you want to invest? Maybe you want to buy a land, real estates. Maybe you invest your money in gold. Maybe you will invest your money in bank. Maybe you will invest your money in mutual fund. Maybe you will invest your money in stock market. What are these? These are the investment alternatives. So investment in equity is high yielding but has more risk, as I have already told you. My father is not interested to invest money in stock market. Why? There is risk. So again there is a proverb, no risk, no gain. To get high gain, better yield, you have to take risk. My father says, no, I do not want to take risk. So the investment in equity is high risk security, but high yield too. The tax shielders scheme offers tax benefit to the investors. Thus, investors should be aware of the stock market structure and the functioning of the brokers, because you have to invest your money through brokers. So broker is the intermediaries in between you and the company. The mode of operation varies among BSE, Bombay Stock Exchange, National Stock Exchange, NSE, OTCI, over-the-counter exchange. Brokerage charges are also different, because the broker through which you want to invest your money will take some charges. So that charges is differing from one to another. The knowledge about the stock exchange enables him to trade the stock intelligently. Now come to stock analysis. Stock analysis, after formulating, this is stock means investment analysis. After formulating the investment policy, the security to be bought have to be scrutinized through the market industry and company analysis. I already told you that after policy, you have to analyze. And what you want to analyze? You want to analyze the place where you want to invest, your money, fund in market. Which market? Financial market. In financial market, where you are investing your money? In industry. In industry, which industry? Cotton industry, pharmaceutical industry, dairy industry, educational industry. Where you want to invest? Suppose dairy industry. In dairy industry, which company you want to invest? Sudha Dairy, Mother Dairy, Amul Dairy, where you want to invest? So, you have to scrutinize through the market, industry and company. So, what is market analysis? The stock market mirrors the general economic scenario. So, this will give you the wide picture of the economic scenario. The growth, domestic product and inflations are reflected in stock prices. The recession in the economy results in a bear market. Bear market, what is bear market? Bear market is the market when the stock price will falling down. So there are two terms, bear and bull. Bull market, bullish market is the market where the price of the stock will increase, and bear market when the price of the stock will decrease. So when there is recession, it means this recession results in a bear market. The stock prices may be fluctuating in the short run, but in the long run they move in trends, that is either upward or downwards. Trend means upward or downwards, up or down. The investors can fix his entry and exit through technical analysis. Now come to industry analysis. The industries that contribute to the output of the major segment of the economy varies in their growth rates and their overall contribution to economic activity. Some industry grows faster than the GDP and are expected to continue in their growth. For example, the information technology, IT and technology industry has experiencing higher growth than the GDP. The economic significance and the growth potential of the industry have to be analyzed. The same way like company analysis, you have to analyze the company, and thereafter after that you have to analyze the industry. Is that clear? Now I will go through the intrinsic and future value. It's also very easy how you calculate the future value. Suppose you are investing 100 rupees into bank. The rate of interest is 10%. So what is the future value after 1 year? So suppose if I say you like this, that if you are investing rupees 100 at the rate of 10%, every year. So how much you will get after 1 year? This is 0 year. You are investing 100. After 1 year, how much you will get? And after 1 year, the amount you will get, that is called future value, and this is your present value. This is what? The formula of this is future value is equal to present value multiplied by 1 plus I to the power n. Present value is how much? 100. 1 is 1. Interest is how much? At the rate of 10%, that is I is equal to interest. 10%, that is 0.10 to the power n is equal to 1 year. This is how much? This is 100 multiplied by 1.10 to the power 1. This is how much? This is 100 multiplied by 1.10. This is how much? 110 rupees. The future value is 110 rupees. This you can calculate with the help of another way also. Future value is equal to present value multiplied by future value interest factor I and n. Present value is 100. Future value interest factor I is equal to 10% and n is equal to 1. If you see the factor table, future value factor table, interest factor table, 10% 1 year, that will give you 1.10. Factor is 1.10 and this is equal to 110 rupees. So, if you calculate future value with the help of this formula and this formula, the answer will be same. So, in this way you calculate the future value. So, here is what you are investing 100 rupees, you are after 1 year you are getting 110 rupees. The value of 1 rupees today is more valuable than value of 1 rupees tomorrow. This is verifying. Now, in this way, after that we will diversify, selection, allocation, and thereafter appraisal. I think the time is over now. So, in the next class we will discuss the diverse constructions and evaluation. Thank you very much.